How do you calculate enterprise value? Enterprise value, EV, is the sum of all ownership interests in a company and claims on its assets from both equity and debt holders. You can calculate enterprise value by adding equity value plus total debt plus preferred stock plus any non-controlling minority interest the business holds and subtracting cash and cash equivalents. To get equity value, you need to find fully diluted shares outstanding and multiply those outstanding shares by the current share price if you're conducting a comparable companies analysis, or by the offer price if you're using a precedent transactions analysis. The market cap value found on Google Finance or Yahoo Finance is not the correct equity value that needs to be included in the enterprise value. The correct value is the one that includes fully diluted shares, and therefore you need to find fully diluted shares, accounting for any in-the-money options and warrants and convertible securities. Now, a follow-up question is, why is cash and cash equivalents subtracted from enterprise value? There are two reasons why cash is subtracted in the enterprise value calculation. One, the cash can be used to pay down debt. So really, we are adding net debt minus cash, to enterprise value, right? That cash can be used to pay down existing debt. Now, in addition, cash is usually priced into the share price of the firm, and therefore, when calculating enterprise value, equity value accounts for that cash already. So if we weren't going to subtract cash and cash equivalents, then really we would be double counting, because we'd already be accounting for that cash in the equity value of the firm. So we subtract that to really remove the effect of cash and cash equivalents. Another follow-up question is, when calculating enterprise value, what changes between a precedent transactions analysis and a comparable companies analysis? With comparable companies analysis, the number of shares outstanding is less than in the precedent transactions analysis due to the accounting of unvested options. When calculating the new incremental shares from in-the-money options and warrants, the treasury stock method, the TSM, usually includes only vested options for a comparable company's analysis, while for precedent transactions analysis, non-vested options are also accounted for and thus more dilutive to new incremental shares. The reasoning behind this is that the non-vested options, the options that are expected to be vested, to be given to employees, awarded to employees in the future, are assumed to be future liabilities. And in a precedent transactions analysis, really the entity will not continue post-transaction. So really those future liabilities need to be accounted for now. And that's why when we're calculating future fully diluted shares, we're accounting for those unvested options and calculating the dilutive impact of those unvested options. Whereas with the comparable companies analysis, we're not saying that the company is gonna stop functioning as its own entity tomorrow, but rather we're just comparing it relative to others. And so really we don't need to include unvested options. Some analysts will, just to go for the most dilutive scenario, but many analysts do not include unvested options. And that's the big difference between equity value calculation for a comparable companies analysis and a precedent transactions analysis.